You know what's crazy? A few months ago, people were calling Opendoor one of the most promising real estate plays in the entire market. Fast forward to today, and it's getting crushed, down more than 8% just today alone. And yet, some traders still believe this might be one of the biggest comeback opportunities of 2025. So what's really going on here? Is Opendoor about to bounce back, or is this just the start of a deeper slide? Let's talk about it. Before we dive in, hit that thumbs up if you appreciate no hype, straight analysis. It really helps the channel reach more investors like you who want data, not drama. Alright, so Opendoor is currently down around 8.19%. Most of that drop is tied to overall market fear. But there's also something deeper happening under the surface. Data points that could seriously impact how Opendoor performs over the next few weeks. The stock hit a low of 6.23 cents, a high of 6.80, but the real concern is the volume. Only about 50 million shares traded versus an average of 242 million. That's extremely light. Now, Opendoor has always been what I call a momentum play. When volume is hot, this thing can move fast. But lately, it's been losing energy. And when you've got a momentum stock with no momentum and a broader market that's turning red, that's not a great combo. Short sellers clearly know this. Right now, short interest is sitting at about 21.7% of the float, which is roughly 153.9 million shares being shorted. And that number's been climbing. So shorts are not backing off. In fact, they're doubling down. They're likely waiting for the big economic data that's set to drop Thursday and Friday. Now, here's the part that really matters. The housing market data that came out this week isn't looking great for Opendoor. Canceled home purchase deals rose again in September. More than 53,000 U.S. purchase agreements were canceled. That's about 15% of all contracts, up from around 13.6% a year ago. On top of that, the MBA Purchase Index came in at 157, continuing its downward trend. And that's a big deal because fewer mortgage applications mean fewer home buyers, and that hits the heart of Opendoor's business. So while a lot of people online are saying this is a screaming buy, the data tells a very different story. The U.S. housing market is clearly slowing down, and Opendoor's model depends heavily on steady transaction flow. And then there's the silence from management. No major updates from CEO Eric Wu, no real excitement coming from the company's social channels, nothing. In fact, it looks like Eric's been on vacation. And I get it, everyone needs time off, but when your stock is dropping and volume is drying up, investors want to hear something. The lack of communication adds to uncertainty, and uncertainty leads to lower confidence. Now, looking at today's broader market, Netflix started this sell-off. Some analysts pointed out their margin concerns, and that just triggered a wave of fear across growth and tech plays. Opendoor got dragged along for the ride. There's been no major SEC filing, no big corporate news. It's simply reacting to the mood of the market. Options activity confirms that. Today we saw about $11 million in call options versus $3.5 million in puts, and roughly half of all those trades were bearish. Bulls still think it can bounce to around $7 to $7.50, but bears are betting on a breakdown below $6. Now let's talk about what's happening behind the scenes, the large block trades and dark pool activity. One big transaction, about $3.89 million at 6.72, seemed to push the stock down even further. A lot of those dark pool trades are likely tied to short positioning, meaning institutions are actively betting against the stock right now. With Opendoor trading around 6.41, it's hovering between support at 6.18 cents and resistance around 6.86. So technically speaking, we're sitting right in the danger zone, below key averages and right where momentum starts to fade out. Now, if you're a technical trader, here's something you need to pay attention to. The 50-day moving average. Opendoor just broke below it, and that's significant. If it closes below that level for 2 consecutive sessions, it could officially confirm a downtrend, and that might trigger even more selling pressure. That's why tomorrow's session is so important. If we don't see a bounce above that 50-day line, sentiment could get a lot worse very quickly. At this point, the company really needs a catalyst, some kind of positive trigger that reignites institutional interest. Because right now, even algo trading is dominating. Lots of small, automated orders moving the price in short bursts, but no real conviction behind them. Compare that to stocks like Beyond Meat or other short squeeze plays that are getting attention right now. They're getting volume, excitement, social chatter, all things that Opendoor is missing. And when you're dealing with momentum stocks, attention equals movement. Without it, you drift lower, slowly but surely. That said, Opendoor does have potential longer-term catalysts. Rate cuts could come sometime in the foreseeable future, and that would immediately help housing-related names. Earnings could also provide a reset if they surprise to the upside. But right now, neither of those things are on the table this week. If you zoom out a little, you'll notice the same pattern repeating. The stock builds up momentum, gets attention, and then slowly fades when buyers disappear. It's not about whether Opendoor is a bad company. It's about timing and market psychology. Right now, the market's just not in a risk-on mood. Now, if you believe in the company's model and long-term story, you might see this as a buy-the-dip opportunity. But if you're trading short-term, this might be a better setup for options. For example, if you had bought puts yesterday, you'd be up roughly 50 to 60% today. That's how quick sentiment shifts can make or break your trades. On the flip side, for bulls with conviction, long calls during periods of fear can also lead to outsized returns. That's how you play against the broader trend, but only if you truly believe in the recovery story. So, the big question is Opendoor losing its edge, or is this just a pause before the next big run? Personally, I think it's losing short-term momentum. But with the right spark, a rate cut, a strong earnings surprise, or even just a wave of renewed volume, this thing can wake up fast. For now, it's all about watching the data. Watch the 50-day average, watch mortgage and housing reports, and keep an eye on short interest levels. Those three things will tell you more than any hype headline or tweet. Let me know what you think. Do you still believe in Opendoor? Are you holding, adding, or sitting out for now? Drop your thoughts below. I love hearing your perspective. And if you found this breakdown helpful, make sure to like, share, and subscribe. It helps the channel a ton, and it keeps you in the loop with all the latest U.S. market updates. This video is for informational and educational purposes only, not financial advice. Always do your own research before making any investment decisions.